Any thoughts on why the accumulation, sudden accumulation, super accumulation of gold by CBs?
Well, look, anybody who has even the slightest brain cell function, in my view, understands that these things are real wealth. When a central banker tells you that central banks hold gold for tradition, you know that they're lying to your face. And of course, there's no accountability today anymore. But if you look at anyone who has any kind of net worth, everybody is holding gold and silver. Why? Look, in my view, this is very simple, and I've been telling people this for the longest time. These are units of wealth. They have been so for thousands and thousands of years, and we don't need any central banker to reassure us of that. If we understand that this current debt-based economic model is eventually going to implode on itself. And of course, they're going to issue another system like it. It doesn't matter. If you're holding physical gold, physical silver, my favorite asset of all time, physical silver. And I tell people, why does Greg Mannarino say that silver is the most undervalued asset in the world? I just look at a couple of very simple metrics, and I urge people to just do a little homework on their own. Look at the Dow Jones Industrial Average, gold ratio, and then the gold silver ratio. You look at these things, you will see how undervalued silver is, and gold too, and platinum and palladium as well. I own all the metals. Everybody knows that. I'm an open book. So, but look, that's why these are real units. These are real things, and why people need to have exposure to not just, in my opinion at least, gold, silver. They need exposure to commodities because they're real things. Right now, the environment is pretty straightforward. The stock market, although we are off record highs, still remains the place to be for a lot of reasons, because central banks are going to continue to support the system, in my view. Okay. But until this risk-on system, meaning cash moving into equities, reverses, and it's going to in a very hardcore way, people need to be taking the opposite side of that trade and looking at commodities, because how this is going to play out is very simple. It's very easy. We have a debt market hyper bubble. Suppressed rates have caused distortions across the spectrum of asset classes, unlike anything we've ever seen in the history of the freaking world. Okay, now that's going to correct at one point. At one point, we're going to get a meltdown here, and the debt market rates are going to spike in an uncontrolled fashion, and no amount of debt buying by central banks is going to be able to fix the situation, because the currency is just the purchasing power of the currency is already getting sucked out. It's going to get sucked out very, very rapidly. The rising of rates in an uncontrolled fashion is just going to melt down the global equity markets. Okay, and it's the polar opposite of what we've been seeing. Suppressed rates have inflated stock market bubbles around the world, reinflated a housing bubble, which is cracking, quite obviously. But again, debt market implosion kills global equity markets, and cash is just going to move from the debt market and from the equity market into commodities, because they're real things. And then you're going to see risk on, turn risk off. Who knows what the value in dollars could actually be, because commodities are priced in dollars, when this whole thing really does turn around. And it's going to, in my opinion. It's just a hyper bubble.
So you're buying, are you still buying precious metals now?
Oh, I haven't bought in a long time, but I've been buying this stuff for so many years. I started buying silver when it was around, I have to say, $8, maybe less, maybe $7 or so, and I've been buying gold since it was less than $700, $700 around $700.
Is there anything in you mentioned equities, and that the Fed will continue to keep it afloat? Is there anything in the S&P that you like, or a sector that you're eyeing that you'd be in?
I think the energy sector, look, hedge funds are placing some pretty big bets on energy moving forward. Now, I'm not saying that we should mimic hedge funds, but I happen to agree that with them here. I think energy prices are going much higher moving forward. I'm not saying if people go out here and buy an energy company or an exchange-traded fund that tracks energy, that they're going to start making money tomorrow. But again, understanding how this is going to play out moving forward, I think commodities and having exposure to commodities or energy is a good place to be moving forward here. I like large cap ETFs. One specifically I have a large investment in is JEPI, Equity Premium Income. It pays a monthly dividend. The dividend is a hedge. I mean, at least you have the opportunity to maybe make some cash if the market continues, if it does go higher. And I don't think central banks are done I also think that the equity markets are going to underperform moving forward. I don't think we're going to see any big moves here or there, but look, all this depends on the debt market. Again, look, when people ask me about the stock market, okay, it's all well and good and fun to look at and maybe be invested in, but it's the drivers. We got to look at the global debt market. The global debt market is the thing that sets the price action for everything else. As a matter of fact, if you could consider that the stock markets of the world themselves are derivatives. They derive value from what's happening in the debt market. If in fact central banks manage to keep rates suppressed and give the resemblance of some kind of stability in the debt market. For example, we don't see a 10-year yield making a yo-yo kind of action. We just see it kind of remaining steady. You see a US dollar on a relative strength basis remain steady. This would be an environment where people would want to put cash to work again in the equity market. But if you have instability in the debt market, a wildly fluctuating dollar relative strength, well, that's gonna spook the equity market. So, I mean, that's how I look at it every day. I don't really care too much what the stock market's going to do. I look at the drivers. The drivers being debt market, 10-year yield, and the relative dollar strength. That's what's driving the markets.